Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi, welcome to this episode of Through the Noise. My name is Heung, a senior investment strategist within our CIO office, and I am happy to join by Manpreet, Gill, our CIO for Africa, Middle East, and Europe. Welcome, Manpreet. Maybe I wanted to start something first from our global market outlook. I saw that we set the tone by saying the glass is currently half full. Now, obviously, it's a positive read on risk. Can you share a bit more on the rationale from a macro perspective for us?
Hi Ray, thanks for having me. Absolutely, I think the big picture you caught it well. It's a glass half full view of markets going into year end. Now there are a few drivers behind this. So the likelihood of continued Fed rate cuts, that remains one cornerstone of a positive outlook on risk assets. If you look at recent macro data, and especially more recently, that means more the alternative private sector data, given the government shutdown is ongoing, a lot of the data we've been seeing remains fairly resilient. And it's visible, for example, in some of the business confidence surveys. And this follows what is proving to be an increasingly extended U.S. government shutdown and resurgence in trade tension with the U.S. and several key trading partners. But on balance, we think where the positive outlook should dominate. Now, U.S. inflation expectations for the next 1 to 2 years, they continue to soften, opening greater room for policymakers to cut rates. And that's why we now expect Fed rates to be cut all the way to 3% if you're looking out to the end of 2026. Now, what that means is that we assign about a 60% chance that the US economy can achieve a soft landing. And a lot of that upgrade is coming from a reduced recession probability of around 20%. So that's especially for the US where a constructive view is sort of coming from. Meanwhile, our expectations of continued policy support in China, they've helped maintain optimism as well. So on balance, we continue to expect policy support across most major economies to help lean against signs of slowing economic data, especially going into year end. And that, of course, supports our more risk-on scenario. And overall, why we prefer equities over bond and cash. Now, trade and central bank policy, they continue to be the two key risks to our view. On the first, Trump recently offered us two examples, in China and Canada, on how policy can change at short notice. So that is something we have to continue to monitor. However, recent history does suggest that ultimately, US policymakers will seek to achieve a compromise or some sort of deal. On the second risk, markets are assuming the Fed will continue to cut rates and support growth. So we need to be on watch for any hawkish surprise that could negatively impact markets.
I see. I mean, that's augurs well. Let me ask a question on gold before we go through the other asset classes. As we have seen, the gold is actually making an all-time high. I think it's hitting 4,356 US dollar per ounce, and then it has retreated by closer to 10% from that peak. So, are we still positive on gold?
We are. And as you mentioned, it's been quite a dramatic few weeks for gold, first with the rally and, of course, the subsequent pullback. But in our view, this pullback is temporary and really driven by a normalization of excessively optimistic investor positioning. We really believe that the long-term drivers of gold remain unchanged. So diversification demand, especially from central banks, remains strong, while gold also arguably offers some hedging characteristics in an environment where inflation is one of the key concerns. Now, it's possible this current positioning normalization still takes another few weeks to fully play out, but looking through that and sort of keeping our eye firmly on the long-term lens, we still view this pullback as an opportunity to add for underallocated investors. Technical support really sits around $39.45 to about $4,060. And long-term, 12 months out, we now believe gold can achieve 4,500 US dollars over the next 6 to 12 months.
Thanks, Manpreet, for that. I saw that we are overweight on equities, right? So can you tell us a little bit more about the factors driving this call and what do we like in equity in particulars?
So our positive factor, our overweights, are really being driven by positive drivers outweighing what are still some of the negative worries out there. So while many investors pointed out to us that valuations remain elevated and US labor market data does remain on edge. But we still believe the more positive drivers, that's US economic resilience, the Fed rate cuts, what is strong earnings growth rather recently, positive earnings revisions, those positives in our view will trump the negative. And that's obviously driving our overweight. Another way of looking at the same point is to look at the signal from our quantitative indicators. So on global equities, for example, our short-term technical quant model remains bullish, and that's interesting because that signal holds despite some of the mid-month volatility. And our long-term stock bond model, which provides more of a dispassionate view on fundamentals, technicals, and other factors, really sort of still highlights supportive fundamentals, healthy market breadth, and improved equity valuations, at least on the margin after the earlier month pullback. So that sort of hopefully helps illustrate why we're still positive on equities at a broader level. In terms of preferences within equities, of course, there's relatively little has changed. So our key overweights still the US, led by strong economic earnings growth, and Asia ex-Japan, which is driven by policy easing and a weak US dollar.
I see. Now, on bonds, I saw that we are underweight and essentially led by an underweight in corporate credit. Can you tell us the reason for the move, in particular in the underweight of developed market IG and investment grade and high yield corporate bonds?
Absolutely. I think one thing I'd point out is that we're still comfortable with the credit fundamentals for developed market bonds. So our underweight in DM high yield and more recently in developed market investment grade bonds, they're not really a function of our higher worries on default risk or any derailing of the fundamentals, but it's really more driven by the lack of relative value as credit spreads have become tighter. So really what we have a risk on view, but it's driven by a preference of choosing equities rather than corporate bonds to express that risk on view, because unlike corporate bonds, equities offer less constrained upside. Now, at the same time, these tight yield premiums over government bonds mean that corporate bond investors are less likely to see significant gains from any further yield premium tightening. So it's really, we expect a lot of the returns are likely to come from the yield on offer by government bonds because the premium offered over and above the government bond yield is relatively limited today.
Yeah, I definitely share the view that the yield premium has been very, very narrow for corporate side of the equation. Um, Turning to the US dollar, can you also share a bit of the view over there?
So on the US dollar, we do expect a brief US dollar rebound over the next 1 to 3 months, but we expect that to be temporary. Now, the context here is that the US dollar index, which many of you know as the DXY index, is fallen by just under 10% this year, which is one of the larger annual calendar year declines in history. So we expect a temporary rebound to hold going into the final months of 2025 as some of the one-sided bets start to unwind. We also think the bar for further dollar negative news, continues to rise. But having said that, I think what's important here is that while we expect a rebound, we are not expecting a return to the prior trading ranges above 100 in DXY. So that most probably will cap any rallies. Now, looking beyond this short-term outlook, our longer-term expectation of US dollar weakness persists. So US interest rates, they're likely to fall much more than those in many other major currencies, and still elevated valuation in the US dollar mean that the market's likely to be more sensitive to weakness once any upward pressures ease. So this weak dollar view, it's not only a currency view, but also one important factor behind why we're overweight Asia Japan equities and also overweight EM local currency bonds.
Thanks, Manpreet, for that. And before I wrap up, maybe share a bit of our, some of the new opportunistic trade ideas that we want to highlight.
Absolutely. And please do take a look at the publication for the full set, but maybe I'll highlight a couple here, right? So on fixed income, we have opened a new opportunistic bullish idea on Asia investment grade dollar bonds. And we expect these to really benefit from stable credit quality and gradually lower US dollar bonds. And on the equity side, we've opened a bullish idea on gold miners at current prices to take advantage of the pullback in gold, as we just discussed. But we've also opened opportunistic bullish ideas on the US pharmaceutical subsector and the utility sector, which in our view helps add some defensive growth ideas into the mix.
Thank you, Manpreet. And thanks for sharing the insight to all of us. And for listener, thank you for listening in. Just as a reminder, as Manpreet had also mentioned, the full monthly global market outlook shall now be out. And so please refer to it for more details. And after all, please stay tuned for our next episode of Through the Noise. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.